According to Christian texts, there are 7 deadly sins. Each of these sins is an extension of normal emotions that we experience in our everyday life. However, when we indulge too much in these emotions, it can lead to problems. But why am I talking about theology? Well, investing is all about managing emotions, and having the right temperament is a critical determinant of success. So, what are the 7 deadly sins to avoid when it comes to your personal finances? Hi, I'm Rishad, and I'm here to simplify investing for you. Before we dive in, if you haven't subscribed to our channel, where our sole aim is to improve your relationship with money, the time is now. Here we go. The first deadly sin is lust. Lust is the excessive love of something. When thinking about our investments, sometimes we can fall too much in love with certain stocks. This applies to assets as well, where someone is convinced that cryptocurrencies, for example, are the only assets to invest in, or gold for that matter, or even small cap equities. Unfortunately, no script or asset is the magic answer to investing success. That's why taking things in moderation and understanding the counter argument for not investing in a security is very important. The second one is envy. Envy is all about wishing you had something that someone else is enjoying. In markets, this happens all the time. You go to a party and a friend tells you that they had invested in this unknown company and now they have made multi-bagger returns. Instantly, you wish you had invested in the same thing. This emotion is dangerous because it can cause you to take unnecessary risks with your money. In your quest to mimic what someone else has, you might damage what you already have. Third, greed. Greed is all about wanting more than you need or can use. Have you ever invested in something and seen it go up much more than you expected? Let's say you invested in a stock and it doubled in a few months' time. It has most likely moved up way more than you originally expected. Let me guess, you still want it to go higher even if that's not justified. That's greed talking. The fourth deadly sin is pride. Pride is a classic sign of overconfidence. It is dangerous to think that your trading system is invincible or that you know more than everyone else. You may have invested in something only to see it go down. The logical thing to do would be to evaluate if your original thesis was correct. Sometimes it turns out to be the case that you may have missed something that would change your original investment call. But if you are still unwilling to change your mind for the sole reason that it means admitting that you were wrong, then oftentimes the market will come back with an answer that will beat that pride back into place. Deadly sin number 5, gluttony. Gluttony is the excess consumption of anything. In the case of personal finance, excessive consumption of financial news and media can be detrimental to your wealth. Whilst understanding what is happening in the market is important, it is too often the case that what you see on the news is just noise. The market goes up or comes down simply because there is a mismatch of buyers and sellers. But news channels and social media will try to convince you after the fact that there is some logic attributed to the latest market movement. XYZ stock has moved up because the CPI inflation print was higher or lower than expected, and this happens minute by minute or even second by second. What's deadly about the excessive consumption of this noise is that it can make investors think extremely short term and trade in and out of investments rather than building up for their long game. The sixth sin is sloth. Sloth is another word for laziness or for avoiding doing something. Have you put off investing for retirement or for your future financial goals? Have you put off rebalancing your portfolio to your asset allocation? You may feel like it's something you can take care of another day, but putting it off for too much time can be costly in the long run. And the seventh and final sin is wrath. The dictionary defines wrath as having a fit of anger or seeking vengeance. Have you had this experience where you spend a lot of time doing your research and buying an asset, only to see it go down in price? If your instinct has been to get angry at the fall in price and double down on your investment because the market is wrong, then that is wrath egging you on. In investing, it always makes sense to take a step back and evaluate if you made a mistake. The market has no interest in whether you are right or wrong. Making sure you can make your decisions when cooler heads prevail is crucial to ensure that you can make better decisions. I can't put it better than Warren Buffett, who said, "The most important quality for an investor is temperament, not intellect." You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. That's it from me. If you found this video interesting, please do hit the like button and don't forget to share it with a friend who you feel is committing one or more of these deadly sins of personal finance. Also, if you don't follow me on Instagram, here is my handle, which is also linked in the description below. I'm Rishad, and I will see you in the next one.